Joe, we're in the midst of earnings season. You like industrials, you like financials, you like materials. We've got a yield that is moving lower and lower. But let's talk about the earnings first. Are these earnings delivering to convince you to the point that you want to stick with that strategy?
Yes. So good morning, Guy. Thanks for having me. And yes, I think that just looking at the numbers from an earnings standpoint, the numbers are exactly where we thought they would be. Actually, they've been a little bit stronger. And so that kind of gives even more credence to our strategy of going and being more cyclically tilted within the portfolios, because the earnings growth is there. The valuations are not really that stretched. And so if you want to outperform and you want to deliver alpha, then that's where you need to be, where the earnings are the strongest.
Hey, Joe, match that with what we saw from the ISM. So a lot of the old economy stocks are going to be part of that ISM manufacturing data, and and we're really seeing some constraints start to weigh on that headline number just a touch. How do you view that?
Yeah, the number actually was not that bad. I thought it was pretty strong, actually. I mean, we dipped below 60, but if you look at historically, ISM, trees don't grow to the sky. But there's still actually a very strong underlying tone there. I think the biggest thing that the market is looking at is that when you looked at the prices paid component of the index, that actually dipped down below expectations, which I think that feeding into the narrative about runaway inflation kind of suggests that inflation may not be as rampant as people wanted to believe. So I think that's actually a good thing there. But you also have a nice new orders component of it, and employment looked pretty nice in it as well. So I think overall it's pretty broad-based strength that is underlying the economy and also going to underpin the markets.
Joe, you said you're pretty comfortable with valuations. Equity markets, what have we had? 6 months higher for the S&P. Same with European markets. They're pushing ever higher on an almost daily basis. You talk about being comfortable with these sort of levels. What would make you uncomfortable? Where do we need to get to where you'd start thinking, actually, you know what? It's time to take some chips off the table.
Now, I think that's a very fair point there, Guy. I think that what we really have is what gives us comfort is that the earnings are actually growing. So as long as earnings are growing and valuations are not really outrunning that, I think you have a fair amount. Although we're making newer highs, the market last month really became less broad. It was more narrow. So I think that right now, once the earnings are catching up to a lot of these companies, and so people are going to take a new look at these companies and think about, okay, well, the valuations are not really that stretched. I think that ultimately, if earnings stop growing, which I don't foresee them actually doing, I think that, as you guys alluded to previously, management teams have done a really strong job of actually getting. Pardon me, sorry about that.
That's all right.
Management teams have done. Yeah, the live TV. Management teams have done a really great job of actually increasing the productivity. So I think that actually gives you a little bit of comfort there that, earnings will actually be still strong and valuations will still be compelling.
Yeah, Joe, at least it wasn't my 7-year-old running into the shot, so you're good to go. Hey, Joe.
I kept the dog out of the room.
Fair enough. The next wild card, though, is obviously the Delta variant. The latest news from New York City is that Bill de Blasio, the mayor, is strongly recommending masks for vaccinated indoors. Now, Fauci seemed to kind of rule out any real lockdown potential, but the idea that you're going to have masks, that people may not do the things that we thought they were going to do, it looks like a stay-at-home recovery. If we have something called a stay-at-home recovery, what does that mean for portfolios?
Well, I think that that is a huge risk. I mean, I'm not a scientist, and I lean to the scientists as far as what we should be doing from a health standpoint. I really don't foresee that we will be back in lockdowns. And, I think, comparatively to last year, there are vaccines. I think we're every day as we go along that we're getting closer to, the antiviral therapeutics, which will also help, and that will eliminate, the need for hospitalizations and the need for quarantines. So I think that you have, the longer we go within this, the closer we get to a solution is actually probably the best way to look at it. And so I think with that, the recovery that we have now with, basically people leaving their homes and going back into the workforce, I kind of really think that's really the way we're going to go. I think there will be some hesitancy along the way. It's not going to go in a straight line. There's going to be some puts and takes, but ultimately I don't foresee it being a stay-at-home recovery.
Well, it's going to be critical to get this economy moving again, because clearly, as Alix was saying, supply constrained at the moment. The ISM data demonstrating that. We'll see what happens on the services side. Putting this all together, you like the cyclical side of the economy. You think the recovery is on track. You think that the earnings story is going to continue to deliver. How does that compute when we have a US 10-year that's yielding 1.18% and is down fairly sharply today? Given the kind of scenario that you're painting, should yields be higher than where they are now?
Unequivocally, yes. The yields right now is kind of a head scratcher. You have yields so you have the Treasury market's very rich right now, and you have equity valuation, or at least reaching higher highs, and so something's got to give there. I think ultimately, Treasury yields are supposed to reflect growth and inflation. And right now, it feels like the market is really has discounted a lot of growth. They think that we're looking out to 2022, and I think the market is thinking we're going to have a lot. The Fed will be less accommodative. There won't be as much stimulus within the economy, and I think that's so the market is thinking that there should be with that mathematics that the actual growth will be a little bit slower, and I think that growth, it will be a lot stronger than that. I mean, as far as what is being imputed in the markets, and I think so going back to earnings being stronger than probably expectations right now, because you look at the estimate revisions are going higher for not only this year, but also for next year.
Yeah.
So those are the things that's going to kind of, eventually investors will get, believe that there is going to be a little stronger economy. A lot of this is obviously being held back by the Delta variant, people not really unsure of how these is going to play out. So I think once we get, a little more comfort as we get into the fall, I think yields will most likely be directionally moving higher.